Okay, it's August 4th, 2026, and welcome to Earnings Unscripted. We're finally unpacking SpaceX, ticker SPCX. This is their very first quarter as a public company. And the paradox right out of the gate is wild. You look at the report for the premier rocket builder on Earth, and somehow they read entirely like an AI cloud giant.
Yeah, that's the bizarre reality of this print. I mean, you tune in for the Mars colony updates, but you get a massive PEC infrastructure pitch instead. The top line came in at about $7.8 billion, which essentially doubled from last year, but they still posted a net loss of 9 cents a share. So they're obviously chewing through cash at an incredible rate.
Right. And the market clearly didn't know how to process that identity crisis. The stock traded up smoothly all through regular hours, but the second the actual details hit the wire, the tape just broke. It reversed violently in after hours and wiped out nearly all of the day's gains. And since we're dissecting some pretty aggressive price action here, I should point out that our analysis is purely personal opinion, never actual investment advice. But watching a newly public megacap fade that hard is so jarring.
I mean, investors got completely spooked by the sheer sticker shock on the cash flow statement. SpaceX deployed over $18 billion into capital expenditures in just this quarter alone. That's a staggering figure. They have a massive cash pile from the IPO, but Wall Street gets very nervous when heavy capital spending accelerates like that without warning.
So wait, the money isn't even going to rockets? I just assumed an $18 billion bill meant they were building, I don't know, a dozen more launch pads?
Nope. Over 80% of it went directly into artificial intelligence hardware. It's almost entirely funding their cloud network build-out.
Okay, well then we have to talk about what the CFO claimed on the call, because it sounds crazy to me. Management is arguing they're seeing a payback window of less than 1 year on those new AI compute deployments. I really need you to explain how sinking billions into heavy supercomputers can possibly function like fast-turning inventory.
It totally defies normal infrastructure math. I mean, usually you buy servers, depreciate them over a decade, and pray your software margins eventually cover the heavy upfront hit. But because of this initial ramp in cloud service agreements, as soon as their chips power up, they're completely saturated with paying workloads.
Okay, wait, walk me through that again. So you're saying they just artificially jacked up the cloud pricing on these enterprise contracts to claw back the hardware costs so fast?
No, that's not quite it. It's not about jacking up prices. It's the sheer velocity of utilization. They aren't sitting on empty capacity hoping developers show up. They added roughly $1.6 billion in incremental infrastructure revenue just this quarter from this new wave of cloud agreements. That's why Brett Johnson made that specific comparison on the call. He said, it's almost like your capital is becoming almost an item that you would put otherwise in COGS because it's moving so quickly and as far as monetization.
That's wild. She's treating multi-billion-dollar supercomputers like they're milk on a grocery shelf. It definitely explains why that AI segment's growth looks so explosive right now.
Right, and they pushed their total nameplate compute up to 1.4 gigawatts to handle it. Honestly, it sounds like Elon Musk doesn't even view these data center buildouts as a serious engineering challenge anymore. An analyst asked how they maintain a competitive edge building terrestrial AI infrastructure compared to their rockets, and he basically just swatted the premise away. He said, the terrestrial data centers are a trivial problem compared to making gigantic reusable rockets, which are launched frequently. It is like, frankly, the New York Yankees going in and playing a Little League team.
Typical Elon modesty. But to actually play in that Yankees league for enterprise AI software, raw hardware isn't enough, right? That's gotta be why they just announced that $60 billion acquisition of Cursor.
Exactly. They need Cursor to build out their enterprise application layer and deeply integrate it with the Grok Foundation model. Because right now, the AI segment's operating profitability is still deeply negative. They dropped about $1.2 billion operating that unit this quarter. Elite hardware doesn't magically create frictionless software margins overnight.
Well, and that brings up a huge structural question. If they're moving that fast and signing off on massive M&A deals, where's all that liquidity actually coming from?
That's where the balance sheet gets really interesting and a little messy. If you look closely, they've got current and long-term related party debt setting at a combined $13.3 billion right now.
Wait, related party? So they owe $13 billion to other Musk entities like X or XAI just to keep this whole machine running?
Essentially, yeah. The filings don't name the specific creditors, but it's clearly a deeply intertwined ecosystem. They're basically pooling capital across the entire Musk universe to fuel this infrastructure sprint.
Which probably explains some of that investor whiplash. I mean, you buy into a space and connectivity monopoly, but you're suddenly subsidizing this massive, messy AI operation right next door.
Right, except management seems completely comfortable with that tension. They're doubling down, and their guidance is just intensely aggressive. They're officially targeting an annualized revenue run rate of $100 billion by this December.
$100 billion by December? Wow. Okay, so that assumes these massive new cloud deals and that whole Cursor integration just land flawlessly.
Exactly. And they expect to keep burning capital at that same extreme pace to get there. But Elon's looking way past this year anyway. His tone on the call was remarkable. He literally said, our internal projections for reaching $1 trillion in revenue, not ARR, but revenue, have moved up from 2031 to 2030. Prior to the IPO, the financial projections we had were reaching $1 trillion in revenue in 2031. We now expect that to be in 2030. There's a non-zero chance of that being in 2029.
I mean, you just have to appreciate the sheer audacity. They're launching rockets, spinning up data centers, and trying to bypass traditional telecom networks all at once. It feels less like a corporate strategy and more like they're building a sovereign nation state. We'll see if the public market has the stomach to actually fund it long term. But for today, I think we'll leave it right there. Thanks for hanging out with us.
Always a pleasure. Catch you next time.
If you like parsing these markets with us, feel free to make this show a regular habit on your commute. It's honestly fitting we just talked about an AI pivot because this entire podcast, from the script to our synthetic voices, is completely generated by artificial intelligence to bring you same-day coverage at literal rocket speed. We're always looking for new companies to dig into, so just drop your ticker requests at earningsunscripted.datamadness.ca, and we'll catch you on the next call.
See you then.